Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. Eric Balchunas is not with us today because he got stuck in Florida.
This is the second time. It's turning into a trend. Here's one more time.
I like to get stuck in tropical places as well. Let's get to the biggest stories in the more than $10 trillion ETF industry. Investors are using a particular ETF to trade the special rebalance of the Nasdaq 100. We'll tell you which one it is.
And plus, pioneering quant investors, dimensional fund advisors looking to utilize a tax-busting design that has so far only been enjoyed by Vanguard. We're going to talk to the firm's co-CEO, Gerard O'Reilly, in just a few minutes, Matt.
And as the heat waves and storms hit the U.S., we're going to drill down into one ETF that seeks carbon-neutral exposure to the electricity market.
And Matt, of course, with Eric stuck in Florida, supposedly. It's my turn to do go with the flow. Let's take a look at where money is moving in this industry right now. We'll start with the inflows. You're actually seeing some love for junk bonds up at the top. HYG taking in $2.1 billion in the week behind us. Big tech also seeing some love as well. The Q's taking in nearly $2 billion as well. And then you pair that with IVV. Of course, that's broad S&P 500 exposure. Some cash going there as well, $1.3 billion. So that's where money is going. Let's take a look at the other side, the outflows from this industry. Up at the top, you have SPY, of course. This is so heavily used as a trading tool. It's hard to get a fundamental read on what $5.5 billion coming out of SPY means, but it's a chunk of change. Then you can see IWF, that is Russell 1000 growth, leaving some money exiting from that fund. And JNK, to pair with those HYG inflows, you are seeing outflows from JNK, almost $500,000 or so, or $500 million rather. But overall, if we zoom out from just the week to week, we know that ETFs have absolutely been crushing it. I wanted to compare this to the mutual fund flows, of course, in gold. You can see that mutual funds have been bleeding money for years now, and at the same time, ETFs for at least 10 straight years have beaten that. And actually, last year was a record rift to the tune of $1.5 trillion in this interesting market, if you can call it that we've had so far this year. The funds are a little lower in terms of the flows overall, but the message is clear, Matt, that ETFs taking in a lot more cash than their mutual fund cousins.
Yeah, and the trajectory looks the same. Katie, thanks very much. That brings us to one of the ETF industry's biggest stories. Quant giant Dimensional applied with the SEC last week to create ETF share classes of its mutual fund lineup. If approved, it would mean potentially big tax advantages for its mutual funds. Joining us to discuss is Gerard O'Reilly, the firm's co-CEO and CIO. Dimensional controls over $600 billion and is the largest issuer of actively managed ETFs. So we're very happy to have you on the show, Gerard. It's clear that if this is approved, it'll be a big win for mutual fund holders. Would it also benefit ETF holders?
Thanks for having me on the show, Matt. And the answer is yes. It would benefit, in our view, both mutual fund and ETF shareholders. And the reason behind that, Matt, again, in our view, is because we think the potential tax efficiencies that ETFs can bring to the table can benefit the mutual fund shareholders. And then mutual funds transact in kind. And the way the Dimensional transacts, we do a little bit of portfolio turnover each and every day. We do a little bit of rebalancing each and every day. And those cash flows can be used opportunistically to potentially benefit both mutual fund and ETF shareholders. So we think that this could be a win-win for both mutual fund and ETF shareholders if the SEC were indeed to grant this exemptive order.
If approved, Katie was just showing the outflows from mutual funds, inflows into ETFs industry-wide. It's been a trend. Does that then turn around for you? And how does that, how do the tax advantages that ETFs have and mutual funds don't also change?
So if it were approved, our view is that it gives a kind of another tool, and this is the way that we view it, to money managers to help improve portfolios and make them even more efficient. What it might do to future flows, we don't really have a strong view on that. Our view is that for our clients, we like to provide the best-in-class mutual funds, best-in-class ETFs, best-in-class SMAs. And so we do whatever we can to improve the structures of each one of those vehicles through time. So I think that additional tool can be helpful for both mutual fund and ETF investors.
So let's talk about the SEC here, because as you and I chatted about last week, whether or not the SEC actually grants exemptive relief there's no real deadline here. And we've seen others try and fail, such as VanEck twice, I believe, in the last decade or so. So when you think about your chances here and the fact that the SEC doesn't necessarily have a deadline to respond, has the regulatory attitude changed at all in your view?
We've had conversations with the SEC staff on this topic previously, and our conversations, in my view, have been encouraging. Our arguments, I think, are compelling about why this can be helpful for investors, and in particular the investors in our mutual funds. So we look forward to continuing to engage with the SEC staff on this topic. When we might get a decision from the SEC, that remains to be seen. But we've had a lot of positive feedback over the course of the past week from other managers in the industry. So you may see more applications for exemptive relief going into the SEC, and that may indeed, raise its visibility with the SEC staff.
Well, Gerard, on that point, that if we see more asset managers come up to the line here, that it could raise the visibility, it seems like a lot of your strategy, your odds for approval depend on other asset managers also applying for that. And to that idea, have you been in touch with some of your peers about applying for this, basically lobbying for this?
Well, I think that our odds for getting this approved depend on the merits of our arguments and the interaction that we will have with the staff, because exemptive relief is approved on a case-by-case basis, typically with the SEC. So our view is, let's get our arguments tight, let's get the conversations continued with the SEC staff and make sure they understand the benefits that we view could be accrued to the shareholders of our mutual funds if they were indeed to grant us this exemptive relief.
Do you have new products planned if this is approved, Gerard, or do you or would you make existing ETFs a share class of existing mutual funds?
Well, we always have new things in the works and are always listening to the financial professionals that we work with.
Specifically for this, in the case of this approval.
In the case of this approval, if we were to get approval, the next step is talk to the financial professionals we work with, but also you need to get a fund board approval. So that would be a case by case. But there are many strategies that we have a mutual fund format, like in micro caps and so on, that we do not have a standalone ETF available as of yet. And so we would look across the range of strategies and work with our clients and the fund board to decide which would be most appropriate to have an ETF share class if indeed this were to be approved by the SEC.
And Gerard, zooming out from just the topic of exemptive relief, if we take a look at Dimensional's lineup right now, you have 31 ETFs. As our intro said, you're the largest active ETF manager. Of those 31 ETFs, all 31 have seen year-to-date net inflows, which not a lot of issuers can say. Where are those inflows coming from? Are they organic, so to speak, or are they basically assets that are coming from other parts of Dimensional stable funds?
After we launched ETFs back in 2020, what ETFs provided us is the ability to work with a broader range of financial professionals than we had done in the past, because there were many financial professionals that used mainly ETFs only. So it's really expanded our opportunity set to work with a broader range of clients, and a lot of those flows have come from new clients, whether they're independent financial advisors or clients that work at large broker dealers or bank trusts. So it's a lot of kind of healthy flows into our ETFs, and you're right, about 16 billion more or less into our ETF lineup year to date.
And I do want to end where we started, which of course is on exemptive relief, because one of the reasons that a lot of people know Dimensional in the ETF industry is because you're very aggressive when it came to mutual fund to ETF conversions. I believe all told, you converted nearly 40 billion of your mutual fund assets into ETFs. If you were approved to issue ETF share classes of your mutual funds, would that effectively put an end to your conversion strategy?
Yeah, you know, the funds that we targeted for conversion were tax managed or tax advantaged. And so 99+% of the assets in those funds were in taxable accounts. And that was the facts and circumstances with those funds. For the ETF share class, I think that it would be case by case. We have to work with financial professionals that we engage with. And some may prefer standalone ETFs, some may prefer ETF share class, some may prefer mutual funds. So it's too early to say yet, Katie, as to what we may do in the future with respect to conversions or offering ETF share classes if indeed we got that approved by the SEC.
All right, Gerard, thanks so much for joining us. Glad we could get you to walk us through it. Gerard O'Reilly there of Dimensional Fund Advisors. Coming up, Cathie Wood fans have gone missing. Her suite of ETFs sees outflows despite posting impressive returns this year. We'll have those details next ahead of a couple of Cathie Wood interviews this afternoon. And last week, we had a chance to catch up with Mike Novogratz. He discussed the chances of a Bitcoin ETF being approved by the SEC.
If it happens, it's the seal of approval from the SEC and the U.S. government that this is an asset. And there is this giant infrastructure. Because remember, it's not just BlackRock. Like I said, Invesco is bigger in ETFs than BlackRock. And there are many players that are going to, and the SEC is not going to approve one. So you're going to have these giant sales forces out there giving access to people that didn't have access before.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with an exodus from junk bond ETFs. If you look across asset classes so far this year, junk bond ETFs have lost nearly 10% of their total AUM. Again, of all the asset classes, what's done the best is your money market funds, those cash-like funds. Of course, we know that. And then you look down the list, equities are pretty much neutral, and then high yield ETFs not doing so great, even though on a performance basis, they are doing well. So not a lot of love despite that performance. It's a similar story if you take a look at Cathie Wood's ARC lineup of ETFs. As you can see, of the top 4 best performing ETFs in her lineup, they've all posted double-digit gains and then some, have not been met with love from investors, actually posting net outflows year to date for all of those top 4 performances. So flows have not followed performance for Cathie Wood. But let's also talk about the big tech stocks, because it feels like that's all we talk about nowadays, Matt. And there is an ETF angle here. Of course, Nasdaq is going to do a special rebalance of the Nasdaq 100 ETF to reduce the concentration. If you look at QQQE, which is a direction fund that's equal weight the Nasdaq 100,
Love it.
In anticipation of that, it saw one of its biggest inflows ever. I gotta say, I'm not quite sure what the play is here.
You know this about me, though, that I love equal weighted indexes.
Yeah.
So I think it's very interesting. Also, I love rebalancing. Did you ever read Ugly Americans by Ben Metrick?
I've never read that.
People make fortunes on rebalancing if they get them right or if they have inside information. Let's talk about this right now with Isabel Lee, Bloomberg Cross Asset Reporter. So we've been thinking about this for a while now. You and John Authors wrote a great column about it. We're getting more information now, and then what? We see the actual rebalancing at the end of the week?
So yes, we don't like inside information, but we like analysis. Yes. So people are trading the QQQE ahead of the rebalance, and the rebalance is interesting because, for instance, Goldman Sachs today said that it's really not going to change the over-concentration much, because they're still going to be over-concentrated, which is why a lot of mutual fund managers have stayed away from these large, heavyweight stocks, which is why they underperformed by around 31%. But because of the rebalance, we're seeing record inflows in QQQE, around 300 million in the last week, and it pushed up the assets to 1.1, which is a record, billion.
So what's the thought process there? If they're going to rebalance the tech benchmark, the Nasdaq 100, to be less concentrated on the Magnificent Seven, I believe we're calling them.
Magnificent Seven, Super Seven.
Yeah, so what's the thought process behind these inflows that we're seeing into QQQE?
I think it's a way to hedge bets, because you don't know which are going to be the biggest gainers or the biggest losers. According to Goldman's estimates, NVIDIA and Microsoft are going to see the largest slice, and Apple is going back to its glory days. It's going to be the heaviest heaviest weight. But that's according to one estimate. So the way to hedge your bets is just to go equal weight, because without the top 7, Magnificent 7, Super 7, the Nasdaq equal weight isn't that high up. It's around 24% compared to the 50 plus Nasdaq.
So, but what's D-Day, and what kind of volume can we expect on that trading session?
D-Day is July 24th, so that's next Friday. So
next
it's
Friday,
the only day I'm going to be looking forward to from this moment on.
It's my husband's birthday, July 24th.
Oh my gosh, Joe's birthday.
Happy birthday, Joe.
Yeah.
But it's going to be a massive day of volume in markets, right? And nothing to do with Joe. People are going to be trading in and out of this, trying to get their indexes, their trackers to exactly match the newly rebalanced Nasdaq 100.
That is true, especially for QQQ, which is the second biggest ETF or heavily traded ETF, because it's going to have to rebalance as well because it heavily tracks the Nasdaq. So people are going to be closely watching that, as well as QQQE and other tech heavyweights and communications heavyweight ETFs. So it's going to be an exciting day, and it's also going to be Joe's birthday.
All right, we got a lot to look forward to. We have to leave it there, though. Bloomberg's Isabel Lee, thank you so much.
Still ahead, we're going to have an electric drill down with CNIC CEO Tim Kramer on the first commodity-based carbon-neutral ETF. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Matt Miller, along with Katie Greifeld. Katie, you have our drill down for today. Since Eric is
stuck in Florida. Since Eric's stuck in Florida, I'll pick up the slack here. Today's drill down, we're focusing on AMPD. You take a look at this fund. It's the CNIC ICE U.S. Carbon Neutral Power Futures ETF. First of its kind since it tracks electricity futures. It only launched back in May, so barely 2 months old. It's taken in about $5 million in assets so far. And to do this, it charges 95 basis points. Let's take a look at the holdings, since that's the really interesting part of this fund. It basically tracks electricity futures from 6 regional power pools in the U.S. It's weighted by its average annual load as measured by megawatt hours. I learned a lot while I was researching this ETF. It also holds carbon allowance futures to basically offset the emissions generated by those electricity contracts. So really interesting mix of holdings here. If you take a look at performance, again, it's only about 2 months old, so there's not too much to look at here. Since inception, on a total return basis, it's off by 2.3%. But as you can see, since mid-June, and since all we talk about now is how hot it is, you can see that the performance has been trending more positive, Matt.
Yeah, very interesting and timely ETF. Joining us to talk about this fund is Tim Kramer. He is the CEO of CNIC Funds, the company partnering with ICE for the product. Tim, thanks so much for coming in. Talk to us about, the timeliness of this release, I think. Just as we get horrible weather or, incredibly hot days, it started to pick up some attraction to investors.
Right. So what happens is the whole thesis of this is the electrification of America. And so electricity is the most consumed commodity in the U.S. on a retail notional basis, but it's not in any ETF, any index, nothing until now. So we constructed this the way that you guys have described it. And of course, when we launched it, it was right on the heels of like a very mild winter. So it went down, as you say. But now that you've got this heat coming in, the fundamentals are kicking back up, and you're seeing this index start to reflect that.
So as we use more and more electricity, and of course the heat means more people are using air conditioners, it's very worrying for a lot of the grids across the country. Do you expect it to attract more retail dollars?
Yeah, absolutely. So first of all, we think just on an absolute basis, electricity is about 2.5% of CPI. So if nothing else, the investor should just take a look at that and say, okay, that's kind of what I'd like to put the money in and have it be sticky money. But then if you want to take a look at relevant commodities, like we said, this is the most used commodity in the U.S. And so you've got Bloomberg Commodity Index, other commodity indexes, but if you don't have the most relevant commodity in there, you might want to reconsider that. So we think that at this point in time, the weather and these other elements are giving us, some added tailwinds, but we still think it's something that should be in a portfolio for the long term.
Well, you bring up other commodity ETFs, and that's what I find so interesting about this ETF is because for other commodities, you have specific ETFs. You have oil ETFs, you have gold ETFs, you even have wheat ETFs, for example. How big do you think the potential market is here for electricity?
So if you take a look at the top 25 pensions and the top 25 endowments in the U.S., so the top 25 U.S. pensions have about 2.5% allocated to commodities. The endowments are about 3%. So if they took a look at those numbers just based upon what they'd want to do for inflation protection or for their commodity allocation, we think this could be very big. The Bloomberg Commodity Index and the associated ones like the Goldman Sachs Commodity Index, they've got anywhere between $800 billion to $1 trillion allocated to them. And so we think the open interest on the ICE future supports several $billion in this without actually denting the liquidity.
Well, to that point that you bring up pension funds, for example, is that your targeted audience? Who do you see as the ideal investor in a product like this?
So the pensions and endowments have been interested in this, again, for the portfolio diversification, because this is literally correlated to nothing. And then also for the inflation protection. And for just their regular commodity holdings, they want to have the most important. And then if you take a look at the high net worth or the family offices, they tend to have a higher allocation to alternatives and or commodities. And so they've been interested in what this looks like. And then if you just take a look at model portfolios, so instead of the old 60-35-5 model, if you were 60% equity, 35% debt, and for the 5% commods, if you did, we'll say 3% in a traditional index and 2% in this, that would be an interesting allocation.
Katie mentioned when looking at the breakdown of the fund that you put carbon credits in there.
Right.
How does that work out? How do you do the math for those?
Sure. So what happens is each one of the individual power pools where the electricity futures are, they will give you publicly available data to tell you what the carbon footprint is for each one of those areas. And then we use exchange-traded electricity futures, and then we use exchange-traded carbon offsets. The EPA gives you data for that. So it's all publicly available data, so it's not somebody doing, black box or something in a vacuum.
And we only have about 45 seconds left with you, but what's next? Now that you have AMPD off the ground, what else are you setting your sights on?
So we've had a lot of interesting inbounds with respect to taking this particular index and ETF and combining it with some of the other ones that are out there and making a hybrid product so that you could take some of the allocation and some of the math out of the hands of the investor and take care of that for him.
All right. Very cool ticker also.
Well, all the other ones like Volt and Shock were taken.
Well,
so
Amped is
I'm
way
amped.
better. I like
I'm
it. I like it much better for that exact reason.
Yeah.
Tim, thanks so much for coming in. Great.
Appreciate your time.
To talk about this product. Thanks to CNIC CEO Tim Kramer. And if you just can't get enough of ETFs, remember that you can listen to Eric and Joel Weber on Trillions. That's their bi-weekly podcast that covers the industry.
And that does it for Bloomberg ETF IQ. Matt, this was fun. Even without Eric, I think we had an okay time.
Yeah, we could do it without him, but we still want him to come back.
Yeah, well, he'll be back next week, of course, on Monday. I'm Katie Greifeld, along with Matt Miller, and this is Bloomberg.